Okay, so what a difference a day makes. On Monday, the market was just bleeding red. Everyone was nervous. Fast forward 24 hours to Tuesday, and it's like all that fear just vanished. So, what caused this incredible whiplash? Well, it really boils down to two massive forces: the never ending ambition of AI and the wild, wild comeback of Bitcoin. Let's break down exactly how this turnaround Tuesday all went down. This sentence right here really says it all. The anxiety that was hanging over Monday's trading session just evaporated. Poof. It was a textbook turnaround Tuesday, where the entire psychology of the market did a complete 180, wiping out the previous day's losses in just a few hours. And the numbers, well, they definitely back up the story. The S&P 500, the Dow, and especially the tech-heavy Nasdaq all ended the day solidly in the green. But, this wasn't just some random bounce. There was a real story here. So what was it? What fueled this sudden surge of confidence? It really came down to two powerful narratives that kind of grabbed the wheel and just took over for the day. And these weren't just background noise either. They were the actual engines pushing the market higher. So on one hand, you've got the AI arms race, which is just heating up again. We got news from OpenAI and Amazon that confirmed the huge spending on AI isn't slowing down one bit. And then, on the other hand, you have this absolutely spectacular revival for Bitcoin. It just roared back to life, and it pulled all of that risk-on sentiment right up along with it. Let's dig into the specific news that fed these two big stories. So what's really fascinating here is seeing how all these different pieces just clicked into place. First, you had Bitcoin's insane rally, which got kicked off by people buying the dip, plus a clever move by MicroStrategy. Then, get this, a memo leaks showing OpenAI is in code red mode. That's like an internal all-hands-on-deck alert to compete with Google's Gemini. Investors saw that and thought, okay, more spending, more innovation, let's go. Then Amazon jumps in, announcing a brand new AI chip and a stronger partnership with NVIDIA. And holding all of this up, two things: record-breaking holiday shopping numbers that basically told recession fears to take a hike, and a huge donation from Michael Dell that just boosted confidence in future business-friendly policies. Now look, while AI and crypto were definitely providing the fireworks, this whole rally was actually built on a much sturdier foundation: the good old American consumer. 203 million. Let that number sink in for a second. That is an all-time record. This single data point probably did more to quiet down fears of a recession than just about anything else. It shows that even with inflation and high interest rates, people are still out there spending. And that gave investors the confidence they needed to start betting on growth again. But it wasn't all quite that simple. If you looked under the hood of the stock market rally, the bond market was telling a much more complicated story. It was reflecting some real uncertainty about where we're headed next. Okay, before we get into the numbers, let's just quickly talk about this term, yield curve steepening. I know, it sounds super technical, right? But put simply, it's just when interest rates on long-term bonds go up faster than rates on short-term bonds. This widening gap can mean a few different things, but today it pointed to a really interesting clash of beliefs in the market. And here's that whole story laid out in the data. The two-year yield, which really pays close attention to what the Fed is doing, actually went down because traders are still hoping for a rate cut this month. But the 10-year yield, which is more about long-term growth and inflation, it ticked up. And why? Well, there are worries about the U.S. fiscal deficit and rising interest rates around the world. So the result is this steeper curve, which is basically the market saying, yeah, we think the Fed might give us some relief soon, but we're still a little nervous about the long-term problems. But despite all those mixed signals from the bond market, stock investors, they made their choice loud and clear. Just look at this chart of the Fear and Greed Index. I mean, what a swing. We went from being in the fear zone yesterday straight back into greed today. It was a total psychological reset in just 24 hours. And for even more proof that things had calmed down, look no further than the VIX, which is basically the market's fear gauge. It dropped, which means traders are expecting smoother sailing ahead. This is exactly the kind of calm atmosphere that gets people talking about a nice, smooth year-end rally. The Santa Claus rally. So all of this brings us to the big question, the one everyone is asking. With the VIX so low and greed taking over, is the market getting a little too comfortable? It just reignites that huge debate. Are we in a healthy bull market, or are we just pumping more air into a bubble in a few key sectors? Let's see what the experts have to say. So, in the bull corner, you've got Morgan Stanley's Mike Wilson. He's not just optimistic about the next few weeks, he's looking way out, forecasting the S&P 500 could hit 7,800 by 2026. And his big argument is that this rally is going to spread out beyond just a handful of tech giants as earnings get better across the whole economy. But hey, for every bull, there's a bear. And this is a pretty sharp warning from Michael Burry, the guy from The Big Short. He's looking right at NVIDIA, one of the leaders of this AI rally, and saying its earnings look better than they are because of all the stock they give to employees. He sees that sky-high valuation as a massive red flag, and that creates some real tension right there. So if you're an investor trying to make sense of all this, how do you navigate it? Well, today's market action really points to two different paths you could take. The aggressive route is to just lean into the frenzy, right? Chase that powerful momentum in AI and crypto. Or the more stable approach is to look past all the hype and focus on that proven strength of the high-end consumer and companies that just consistently grow their dividends. And here are a few ways to maybe put that into practice. An aggressive strategy might mean looking at funds that focus on semiconductors, the guys making the chips for AI, or products that track Bitcoin directly. The obvious risk? Extreme volatility. It's going to be a bumpy ride. A more stable path could focus on funds that target high-end consumer brands or companies with a solid history of dividend growth. The biggest risk there is if inflation makes a surprise comeback and spooks shoppers. And that really brings us to our final thought for the day. The market today voted, and it voted overwhelmingly for optimism, all driven by these huge stories in AI and Bitcoin. But with some really credible warnings about bubbles echoing in the background, the question we're all left with is a pretty critical one. In this mad dash for the next big thing, are we paying enough attention to the risks? That's the tension that's really going to define this market as we close out the year.